Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for today for about the next 20 minutes or so. We'll be short and sweet on Options Guide TV. So our outlook has been, and we talked about it for quite some time, that the election needs to get out of the way and let the market run. And so far, that has what's happened. To be blunt, I don't know how to be coy about it. But the VIX index was probably the biggest position that we've talked about here on Options Guide TV that I actually have inside my portfolio. Had a little bit of a bonus where we had the VIX index actually run up to around the 21, 22 range the week of the election, which was a little bit surprising, but that allowed us to actually add to our position. Most of the time, most of the month of October or the end of October, the VIX was trading as high as 19 or 20. Since the election, we've also had a Fed meeting, and today we're actually seeing the VIX index down below the 15 level, 1475. Now, my forecast or anticipation wasn't that the VIX would drop that precipitously and that the market would be this strong. So we actually went out to the November expiration in the VIX, the normal monthly expiration. And that was just in case you're worried about with the election. The election needed to be over with. And if there was if it was extremely close or whatever, there was a contested election, then we just wanted to have a few extra days. So the November 20th expiration actually has 12 days remaining until that expiration date. I was anticipating that I'd probably wait closer to the date before we took the position off, but I also didn't think that the VIX index was going to go below 15 after the election, especially, the Fed meeting didn't hurt things to get that out of the way also. And the Fed did, as expected, no surprises, cut by 25 basis points and didn't give any hints as to what they might do in December. Now the chance of another 25 basis point cut has actually gone down. It's around a 50% chance. It was a little bit higher going into the Fed meeting. But what's really been befuddling about the market is that interest rates. That's the hardest thing to get your hands around, in that the Fed keeps lowering rates as far as the Fed funds rate is concerned. But the bond yields on the 10-year on almost all the treasuries have been creeping higher, and which is the exact opposite of what you would anticipate after a Fed meeting and a rate cut. Now, there has been times in the past where interest rates have crept higher after a rate cut. That has happened more than once. It's the marketplace is kind of saying maybe you did too much too soon, or anticipating that new policies might be increasing the inflation rate. Those type of things, but it's really sticky. That's what's very odd about it, is most of the time those type of things will happen for a week or two, where you see yields go up after the Fed's basically stance is that they're going to lower rates. But it's still, even after this last meeting, we're still seeing the yields, be sticky, for lack of a better way of saying it. So let's start by just looking at our VIX position, and we're more than likely going to say that we would officially close out of the position. In my own portfolio, I actually had a limit order in to sell it for 275, and I already got out of that position because of that limit order. But here, let's go to the Tradier Pro software. We have the November 20th expiration that I'm showing you. S&P 500 index is still staying strong. That SPX 6000 hat, you better have it ready, because we're at 59.95.43. So the 6,000 level is within reach, without a doubt. Up 22 points on the day, or 0.37%. The VIX index is at 1472. It's down 48 cents on the day, or 3%. But more importantly, it's down 48 cents. It's below the 15 level. I really thought that it would stay around that 15 level. That is kind of where the VIX wants to hang out nowadays. But it is even creeping lower. But then again, we're looking to set all-time highs. So everything's rosy, I guess, as far as the markets are concerned. And if I look at the November 20th expiration, the 19 strike option contract, that was our long side of our equation. And then we sold the 16 strike. And right now it's saying it's $2.58. Now, there's a lot of play in this number. If I executed my trade at 275, so I would just put a limit order in. I would try to sell it somewhere near that. 258 is where it's at right now. 265 wouldn't be bad either. I also just don't want anything. I'd like to be out of it over the week before the weekend comes, if you possibly could. And 275 is a fair price, giving up a quarter, because remember, the max difference is the difference between the strikes, 19 and 16. So the maximum that it can trade for is $3. In different times, I put chunks on in this trade in my own account at 157 is one of the prices that I paid for the net debit on the put spread. And 160, there was a lot. And then that little treat that we had, that little run up that we had prior, right before the election, I was able to get some done for 125. Now, remember, the VIX futures contract is still driving this. As we're getting closer and closer to the expiration date, the spot index, or this actual value, matters a lot more. But if you look at where the futures are at, once again, you got to kind of jigger, kind of finesse it. You see that at the 15 strike call, we'll just focus on the asking price. We're at 107, 1.07. If we go over to the put, we're at 58 cents. Then you go to the 16 and you see this is 68 cents. And then you go over to the put and you see it is $1.28. So based off of that information, the actual futures contract is more close to the 15 level. It's more, and I guess that in my mind would make a little bit more sense. It's overshot on the actual VIX index to the downside. Overshot is, I don't know, how can you really know exactly where the volatility will be? I mean, that was a strong way of saying it. But the actual futures contract is trading somewhere between 15 and 16. And I think that was lower earlier or yesterday. And now we're seeing it at 258 right here. If I had this position on still, and I do got a few more contracts, but 265, maybe put in that limit order. Since we got 1 day, if you can get another 5 cents out of it, I think I would close out the position. Just don't want to take the risk over the weekend of what might happen, and if we get a spike up. Feel pretty strong about the market staying strong, especially going into the new year. And yeah, I guess that sums it up. If you have any questions, and I do see we got a couple of comments here. Doug is kind of just sharing his view with us. Let's put that up. I expected more uncertainty than we got. And I agree with that, Doug. That's actually a good conversation. I guess I did too. The market really wanted I think the election, and I don't necessarily mean Democrat, Republican. I'm not trying to make anything political, but they just did not want a contested election. And the fact that it was not contested and we knew who won the presidency so quickly, the markets really were happy about that. And I guess nobody necessarily saw that coming. And that's part of the reason why I think we sold off so much on the VIX. That's once again, I'm just opining on the situation. That's my rationale behind it. But the VIX is where the VIX is. The futures contract's at 15. The actual spot index is at 1472. Yeah, did not anticipate it coming down this hard, this fast. And then Mega comes in and says, what do you think about long call for VIX expiring between Feb and May, since it is pretty cheap and the market is way high at this time? No, I don't, Mega. I'm not. I trade the VIX when, I think if you go back and even watch a lot of the Options Guy TVs, when there's opportunity, I don't look to try to find a trade in the VIX. The trade has to come to you. And I don't want to sound like I'm a Buddhist monk, but if you are, the last time we did a trade on the VIX was the end of August, just going into September. And part of the reason why was just the seasonality of the VIX. So we got long calls then. And then the market actually came back down again, and that gave us an opportunity to get long some call options, or I should say call spreads. Actually, we did butterflies. That's what we did. So we did a butterflies in the VIX going into September and going into October. So you can go back and look at those trades that we did on the VIX. But now going into Christmas, I don't know. I don't have an opinion. I don't have anything in my head besides unknown black swan event, like you're kind of hinting at. And we put this VIX trade on because there was a known event, and it was very obvious that it was messing with the markets. It was very obvious that in hindsight, it's usually always obvious, but in my mind, it was pretty obvious that the VIX and the Fed meeting all being in that 1 week, or I'm sorry, the election and the Fed meeting being in that 1 week, that was going to take a lot of the volatility off the marketplace. Now, there could have been, anything could have happened in that period, as far as news and the geopolitical concerns that we have just across the border. So anything could have happened. But those two things were the issue that was keeping the VIX around the 1920 level, and got that little treat where it ran up to 22 just prior to the election. So no, I do not want to get long any VIX right now, because I don't have an argument as to why I want to do it. I don't want to do it just because there might be a black swan event because the markets are running up towards all new highs. That's not my rationale on trading the VIX. You're right. Oh, okay. Patrick went and actually looked at the futures and said it was 1545 is where the futures are at. Yeah, that makes sense. It's just easy to look at because it's, once again, it's not, there's not an exact science on how well, I guess there is an exact science, but where the options are trading or where the options are trading. It's good to know that approximately the future is 1545, right? If the future was down where the spot index is at 1473, I would assume that we could get out of this trade at 275. And I did execute a few of my trades at that level. Now, the other thing that has happened is the VVIX. The VVIX is also kind of interesting to see. And if you want to go further with the talk on volatility, let's pull up a chart. Oh, come on. My computer just froze. There we go. Let's pull up a chart on the VVIX. Now, what is the VVIX? That is the volatility of the options inside the volatility index. And this has also helped the trade. So this is one of the things that was beautiful. That is beautiful about the getting bearish on the VIX, is that if the markets are going up, implied volatility usually has a tendency to come down. So let's look at, this is going all the way back to August there. Okay. So this is what has happened for the volatility of the options inside the VIX index. We were going into the election, that was at 121. And now we see it at 88. So this is kind of the bottom, kind of the level in the sand. It's very rare that it goes below that. So the VVIX is what the VIX is. The VVIX to VIX options is what the VIX is to S&P 500 index options. So that coming off on a spread that we're correct on helps us without a doubt. There's just not that many opportunities to just be bluntly short in the VIX index like this one. And then if another opportunity comes out, we'll do it again. But I probably won't trade the VIX going into the end of the year. More than right. All right. Any other questions on the VIX? So I just want to get bullish on things, especially going into the end of the year. There's still a euphoria from the election. And the one market area that has done well this year are the financials, but they're still undervalued relative to a lot of the mega cap tech, but relative to a lot of the other stocks in the S&P 500 index. There's a fairly decent bump up. Interest rates are coming down a little bit. They're kind of, they even a little bit lower still doesn't kind of helps out the banks in their scenario. Too high of interest rates, mortgages and refis and all those different things in that financial sector can get hurt. So we're kind of getting more towards that sweet area as far as where the interest rate should be. And the marketplace has shown that just recently. So we're going to do the XLF. Now, I don't mind. JP Morgan has been a big winner since the election. Charles Schwab, I've always liked that stock, mainly because just the way that, well, they brought the industry down to zero commissions. They're the first ones to go and everybody followed them. And they knew what they were doing when they did that. They ended up making a couple of acquisitions. They knew that there were other big brokers that had cash piles in, but the way forward was to them to charge commissions. And, I just like the strategy that they did. So those are a couple of independent ones. But in general, I'm just going to do the XLF. And I'm going to do a very simple trade today, and I'm going to call it a day. We're going to look at the XLF. And the XLF right now is trading at 49. Don't mind just buying 100 shares of it. It's not that hard to do that. $4,900, you can buy 100 shares. And if I want to go in and buy option contracts, the way that I'm going to do it is I'm going to go out to, once again, the euphoric period to me after the election is going to be going into January. So you have president-elect now in not making policies. The old administration is there. There's not a lot that's going to happen, more than likely from this point going forward. And I do feel like the sentiment will be just positive in general until things start happening again in the government. So this time period as an option trader, I just want to get bullish on stuff. So at this point in time, I like this sector. If there's other sectors, look for a sector index, maybe buy some options on it. So here's the sector that I like. How am I going to do it? If I'm investing more than speculating, I'm going out 70 days, and I don't even mind if you go out to February or March, but we're going to go just out until the new year here on Options Guy TV. And we're going to go a little bit deeper in the money. So the delta that we're looking for is somewhere around an 80 delta. And this trades at a decent, look at the volatility. The volatility is way off. So once again, the VIXs came down. The volatility on a lot of times this will trade closer to the 20% level. That's about, I think, like Schwab and JP Morgan are maybe 25%. So you get a little bit of a break because you're doing basically an index, right? Index of financial stocks, the XLF. That's the ETF that tracks something similar. And I'm going to buy that 47 strike, 2 points in the money. I'm going to be able to get into that trade, get 70 days, get an 80 delta, get a lot of stock price representation and a decent market, 310 by 320. So I'm going to come in, we're going to say we're going to buy this at 315. A lot of open interest. If I looked at the volume, there would be decent volume in it too. And that's going to be our trade for today. So I'll make it official. And if you have any other questions, feel free to put them in the comment box right now. But this is going to be my official paper trade for today. And that is, we're going to buy 147 strike call with the January 17th, 2025 expiration, which is 17 days away. And we're going to buy an 80 delta option contract. Right now, the midpoint is $3.15. A little bit, well, actually, that's the ask. Okay, so I'm going to keep it right there. $3.15 is the price that I would be willing to buy this at. And that's $315 is your risk. Obviously, always manage your leverage when you're doing a trade like this. But I'm willing to hold this for actually maybe going into the new year. If I double on it, I want to consider myself getting out. If the market comes down to the 47 level, this would be the at the money option contract, right? So if it came down to the 47 level, you're looking at it trading somewhere where the at the money is trading right now, right around $1.64. Now, obviously, that's as of today, but this is one way that I always like to try to equate my risk. If it did come down to that level, I would think about getting out. If I did get that, and that would be a decent move to the downside, right? A 1% move is 55 cents. So we're talking 4% approximately to the downside to get down to 47. And then I would be looking to sell right around 166, somewhere in that range. It'd be somewhere between these two numbers, right? 49 and 50. So what I'm saying is that if the market came down to that level, this option contract would react like where the at the money option contract is right now. All right. Would you like to sell anything near term against it, or just have clean upside? Just one clean upside. I'm bullish, and especially if I don't mind the concept, Doug, of I don't mind the concept of selling a call against the position, maybe looking at the December contracts or whatever, but I don't want to get too fancy with it. Right now, the market is euphoric and the market just wants to go up. And like I said, this grace period before we get into the new year and the new administration, I just think the euphoria is going to continue. And the interest rates came down, and the Fed lowered interest rates, which should kind of help out financial stocks, and we'll see where we end up at. All right. Any other questions that we have? All right. I'm going to call this a day. Tapping out a little early, I guess, on Options Guide TV this Friday. Have a great weekend, and we will see you Monday morning for the next edition of Options Guide TV. Follow me on Twitter if you would like to see anything else that I'm doing across the board. My handle is @BrianOverby, and thanks for stopping in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.